Thanks for tuning in to the weekly Signature FD audio cast that we call Cutting Through the Noise. I'm Tony Welch, Chief Investment Officer at Signature FD. Now we're going to start with our chart of the week, and we titled this Zoom Out. This chart should be familiar. It's just a long-term chart of the S&P 500 index. Now, overlaid, there's vertical lines here, and these are what our friends at Ned Davis Research would call crisis events. This includes wars, the Lehman bankruptcy, COVID, and many others. And what really stands out is that most of these events appear trivial on a long-term chart, and this chart doesn't even include reinvested dividends, which would even further make the point. Being able to zoom out and focus on the long term, that's something of a modern day investing superpower, especially in a world of 24/7 news and social media. Now, on to the impactful economic data from last week. Maybe the most important data point was the GDP report for Q1. And that showed us what sort of shape the economy was in as we headed into Q2. Now, we can see here that GDP actually showed a mild contraction in the first quarter. That was primarily due to a surge in imports as purchasers were attempting to front run tariffs. When we look at real final sales to domestic purchasers, that's the orange line in this chart, we can see that number was 2.3%. Now, that metric essentially strips out the trade impact to growth. So 2.3%, that's okay. It's below average growth, but it is still positive growth nonetheless. It's clear that the economy is slowing, but not clear that a recession is imminent. Now, we also got a lot of data on jobs last week, which also generally showed a softening trend, but not yet recessionary. One data point that caught our eye was the percentage of unemployed persons which have been unemployed for over 27 weeks. The black line in the middle clip here shows that that metric ticked up to 23.4%, and that's a new cycle high. So companies are not necessarily conducting mass layoffs right now, but job seekers are having a more difficult time finding a new job. Perhaps counterintuitively, the market has been in rally mode the past several weeks. In fact, the S&P 500 gained on 9 straight sessions through last Friday. We can see here that the large cap US benchmark is now only down about 3% on the year. Still, international markets have been notably stronger, with developed international markets up 13.7% and emerging markets up 6.3% on the year. Geographical diversification continues to make sense to us. This also tells us that investors believe that much of the economic weakness could prove temporary if trade policy becomes more certain. Now, one reason for optimism has been that Q1 fundamentals appear to have been quite solid, if not downright strong. So, this chart from Wisdom Tree is tracking the earnings announcements in real time. And on the left, we're showing sales growth, and the right shows earnings growth. About two-thirds of the companies have reported, and thus far, sales growth is over 4%, while earnings growth has been about 15%. That implies that there's been some profit margin expansion, which is notable because companies may be able to temporarily absorb some tariff costs without passing them on to the consumer. Now, the longer that tariffs remain on the table, the more likely companies are to try to pass them on. But for now, corporations and their fundamentals are in good shape. Now, one of the reasons that companies may not want to try to pass through too much extra cost to the end consumer is that consumer confidence has been softening. This chart here shows the 3-month average of consumer confidence in blue. Note that it's getting close to pandemic levels. Consumer confidence correlates with spending, which is what we show in the orange dashed line. Weakening confidence is a risk to the economy and corporate earnings. But again, the market rally implies that confidence may return if some trade uncertainty is alleviated. Now, one way to think of the current economic as well as the investing backdrop is that the range of outcomes is just likely wider. That's especially true in regards to stock investing. Valuations are elevated, implying that outcomes likely need to be positive to support stronger returns over the next decade. This chart shows the median 10-year annualized return given different levels of starting valuation. Now, today we're in the far right. That is extremely overvalued. Note that historically, returns have been a median 5.7% with a low of negative 6.5% and a high of 15.1%. So, high valuation isn't necessarily a death knell to returns in the next 10 years, but it does mean that we probably need a lot to go right. I think this view is interesting because it does show that rich valuation itself doesn't mean that the next 10 years will be miserable, just that there's less margin for error. Because of the wide range of outcomes that are now possible, we think diversification matters quite a bit. This chart from JP Morgan shows stock and bond returns during recessions here on the left, but it also adds in alternatives in the form of hedge funds, infrastructure, transportation, and real estate. The implication is that we want to own several assets that have low correlation with each other and positive expected returns. Bonds tend to hedge well in recessions. Alternatives tend to hedge well in inflationary shocks. So, some closing thoughts for the week. Markets have rallied as tariff policies have shifted and Q1 earnings have been strong. Valuations remain elevated, and we need to be cognizant that the range of outcomes is likely wider over the next 10 years. Economic data is consistent with a slowing economy, but not a recession yet. Real final sales to domestic purchasers, that metric strips out trade, that was still positive, albeit weaker than average. The job market's holding up, but some cracks have been forming. Long term unemployment and permanent job losses have picked up. Consumer confidence has softened, and that is a risk to consumption. Stay disciplined and think long term. The ability to block out the short term noise is a modern investing superpower. As always, thanks for joining us this week and have a great week ahead.